All right, guys, how's it going today? So today, by special request from someone in the group, someone wanted me to go over IV Crush, okay? And hopefully this video isn't as long as some of my others, like the calendar spread. It shouldn't be. I don't really time these before I do them. I just kind of, I make my notes and then I just dive right into it. So this one, IV Crush, I'm just going to kind of go over some important talking points for you guys. And hopefully you find it helpful. If you find it helpful, hit the like button. And yeah, all right, let's get into it. So before we get into IV Crush, I just want to briefly go over what implied volatility is, right? Because that's important to understand what implied volatility is, right? I'm not going to go into a ton of detail on implied volatility, just so you understand the basics of what you need to understand. Okay, so first, what is implied volatility, right? So implied volatility is the market's forecast of a likely move in a security's price. Okay, so how likely is something to move, right? Or by how much, right? The higher the IV is, the more of an expected move there is, right? If I'm just using arbitrary numbers here, but if the IV is like 50%, let's say stock of $100 a share and the IV is 50%, right? There is a 68% chance that the stock will be somewhere between $50 to $150 per share over the next year, right? If the IV was 75%, well, then that range is even bigger, right? So that $100 stock would be expected to trade maybe between 25 and 175 over the course of the year, and that would be under the 68% occurrence, right? Just based off the standard bell curve and statistics. Okay, so it is used to project future moves and the likelihood of those moves. Okay, IV is often used to price options contracts where high implied volatility results in options with higher premiums and vice versa, right? So when IV is high, options are high, okay? The stock itself has its own IV, and then the options themselves have their own IV, right? So that example I said above about the stock that's $100, like that's the stock's individual IV that I'm talking about, okay? So IV doesn't necessarily predict the direction in the price change, okay? It's just giving you the range up or down, right? So high volatility means a large price swing either up or down, okay? Or fluctuate somewhere between the two directions, okay? Low volatility just means that the price is likely, it won't make any broad changes, okay? No large, broad, unpredictable changes, okay? IV determines the expected move and one standard deviation above and below price, okay? So that's kind of like what I was saying above, right? Which states there's a 68% probability a stock will stay within that range over a given time period, okay? It's 1 year by default if you're looking at the IV on a current stock, okay? Now, you can calculate that based on the days, right? Like what's the probability or what's the range over a month, right? So, to calculate the range based on X amount of days, you can use the formula stock price times IV times the square root of the number of days divided by 365, okay? I don't do this, because, you can if you want. But Thinkorswim and I think most other platforms will actually just calculate this for you, right? And it's the expected move in Thinkorswim. In fact, let me see here. Okay, let's look at Tesla real quick. I'll get to this real quick. All right, so if you see right here where I just selected here, April 1st, that's the expected move, 66, right? So Tesla is expected to stay within that range, 66 points above its current price and 66 points below its current price, 68% of the time, right? There's a 68% chance that it will stay in that range, okay? Multiply that by 2, now you have a 95% chance that it's going to stay in that range. Okay, I hope that makes sense to you guys. Okay, but that's this area right here on the right hand side of the screen, right underneath where it says delta there. That's your expected move on Thinkorswim, right? So I use that quite often when I'm setting up some of my trades, right? Some of my option spread trades, calendar spreads, butterflies, things like that, right? I use that to my advantage to know what the probability is, like the actual true statistical probability of the likelihood of a move happening, okay? All right, so back to this. So implied volatility usually increases in bearish markets, right? Which we saw here recently in January and February and March of 2022. Okay, VIX was going up across the board. IV on individual stocks was going up, right? Tesla's IV was going up, right? And it decreases when the markets are more bullish, right? That's just how it is, right? That's generally speaking, that's how it is. So the IV often increases leading up to certain events in certain instances, right? So leading up to individual stocks earnings reports, right? And that's very powerful to know, right? Because you could take advantage of that expected increase in IV called IV rush, which is the opposite of IV crush. And it immediately drops after the earnings report is over, okay? Now, the IV will increase as you're going up into things like the Fed meeting, FOMC, or any kind of event where like news releases are going to be released, or Apple, like if they're releasing their their numbers, or Amazon's releasing sales on Prime Day, something like that, right? Now, with increasing demand in options also comes increasing IV, right? So the more the demand increases for those particular options, IV is also going to increase. Okay, so that's important to know. IV on options is generally lower on farther dated options, okay, but vega is generally higher, okay? So how is IV related to the Greeks? I think this is important to know as well. So higher IV means you're going to have higher deltas, okay? And vice versa, right? Higher IV means you're going to have lower gamma. Higher IV equals higher theta, vice versa, right? Higher IV equals higher vega, okay? So let me go over this real quick. What is vega? Okay, so vega basically measures how much an options contract price changes per 1% change in the implied volatility, right? If you guys don't understand the Greeks before watching this video, please look it up. It's very important to understand the Greeks if you want to trade options. Just my opinion, okay? Vega is highest for at the money strikes, and it's higher for longer dated options, okay? And this stuff is important to know if you're setting up multi-leg option spreads, okay? Just be aware of that, okay? I have a video where I actually did a webinar of all the options Greeks and of multiple different spread types, and I talk about all this in great detail. So if you guys want that information, let me know. Leave a comment in the comment section or ask me in the Discord, okay? Option buyers are long vega, okay? That means they benefit from increasing IV, okay? So if you're long vega, you want IV to increase, right? If you're short vega, you don't want IV to increase, right? Option sellers are short vega. They benefit from decreasing IV, right? If you're short vega, you don't want IV to go up, okay? So now that we've gone over all that, let's talk about IV crush. So what is IV crush and why is it important, okay? So it's the tendency of a significant drop in IV after certain events are over, okay? Earnings reports, Fed meetings, etc., like I said above, okay? And this happens because of all the uncertainty around the event is now over after the information has become known to the general public, right? Numbers are out. Earnings per share is out. Revenue is out, right? Everyone already knows this stuff now, right? So the uncertainty is gone, right? So the IV drops, right? And that drop in IV directly impacts the price of options, right? You have to understand this, right? These Options contracts are very fluid. They're, pseudo complicated, right? If you don't understand them, right? IV really affects the price of these options. Okay, I mean, there's been certain situations where I've held a call and the price didn't move at all, but the contract went up like 50% because all of a sudden the IV started going up, right? Which is good for me, right? If I'm long those calls. So just be aware of all this stuff, okay? Because you can end up in a situation where you end up losing money and you don't even know what the hell happened, right? You feel like you were robbed, right? So it's important to understand all this stuff. So I got an example for you guys. So for example, and I did use the options chain for this a while back, so this is pseudo accurate. So you are long 200 strike calls on stock XYZ, okay? Before an earnings report, and it's currently trading at 180, right? So you're doing a $20 out of the money strike call, okay? And you're paying a 2.00 debit for it, okay? The vega is 0.10, and the IV is 70%, okay? The delta is 0.20. The following morning, they release ER before the bell, and they move up $5 a share to 185 a share, okay? IV then drops from 70% to 50%, okay? The stock then gains about $100 from the delta, right? Okay, and you being right, and from you being right on the direction of the movement, right? However, since the IV dropped 20%, and vega is 0.10, you essentially lose $200 just from the IV crush, okay? Right? So in the above example, even though you were right on the direction, you still lose money due to the IV crush, right? Because you only made $100 on, and I'm not even factoring in theta here, right? Like you're going to lose money on theta as well because one day has passed, right? So even not accounting for theta, you're losing $100 even though the stock moved up $5 the next day, right? So, if you don't understand IV and IV crush, you might be like, well, what the hell? Like, why did I lose money? Because I had a call and the stock moved up. I was right about it moving up, but I still lost money. What happened? That's what happened. IV crush happened to you and your ignorant ass that didn't understand IV crush, okay? So please, please, please understand IV crush, IV rush, and all of the Greeks, okay? So what can we do about that? How can we avoid that? How do we combat IV crush, right? Option spreads is the obvious answer, right? Option spreads help negate the negative effects of IV crush compared to just playing naked calls or puts, okay? So for example, and actually I used the options chain for this here recently, a naked 1050 strike weekly call on Tesla has a vega of about 0.42 just by itself, okay? But if you use a debit spread where you buy the 1050 strike call and sell the 1075 strike call, well, your total net delta is only 0.07 compared to 0.42, right? So your vega is 0.35 less, right? So if you get a 10% drop in IV, and we're just talking about a 10% drop in IV, right? That's the difference of losing $420 and $70. That's a big difference, right? So having that debit spread through, an event like that helps a lot, right? I don't think in the last 2 years I've wrote a naked call or put through any earnings report. And I play earnings reports a lot. And I have not played any naked calls or puts since then, knowing what I know, right? Maybe I have, but it's, it was a complete YOLO gamble of like maybe $100, on a cheap stock. But, 99% of the time, I'm not playing anything naked because it's just, you're shooting yourself in the foot. So this way you are affected much less by collapsing IV and are more focused on where price is in relation to your spread, okay? So this would also lower the break-even price at expiration also, so that's important to know. The break-evens on that debit spread mentioned above would be about 1055 compared to 1070 on the naked long call, right? Assuming you hold it till expiration, right? So again, that's a big difference too. You can also use longer dated expiration strikes, which aren't as affected by IV crush, right? So those near term option contracts, those IV crush the most, okay? Longer dated ones, those don't experience that IV crush as much, right? If at all, right? So there's times where I actually I'll hold leaps through through earnings reports. Like most recently, Qualcomm, not the most recent one, but the one before that, I held a lot of leaps through their earnings report, and that paid off big time because Qualcomm moved up like, I can't remember exactly, like 20 points, and those contracts like tripled overnight. And again, like the IV really didn't affect the contract all that much. It was more affected by the delta, right? And theta is also a lot less on those longer dated contracts as well. So if you are going to ride calls or puts through an earnings report, at least go, 1 month out, right? Or just do leaps, right? Do like 6, 8, 9, 12 months out, right? So can we benefit from IV crush? Absolutely we can, right? So, like I said above, talking about short vega, there's a number of option strategies that benefit from drops in IV, i.e. short vega strategies, right? So what option strategies benefit from falling IV? Okay, so basically any options where you're selling, right? So any option selling strategies, you're going to benefit from falling IV, right? So, if you got a big account and you're into selling puts, that's another good one, right? It's a risky strategy. You got to know what you're doing, right? I know plenty of people that sell puts through earnings reports. I know people that sell straddles and strangles through earnings reports, right? Not my cup of tea, but people that sell one standard deviation strangles through earnings, they make good money. I know a couple people that's all they do, right? They just sell strangles through earnings reports, right? And they make a living off of it. It only takes 15 minutes of their time, right? But you need, a pretty big account for something like that. So again, short calls, extremely risky. I don't recommend selling naked calls ever, ever, ever. It's just way too risky. You just never know what's going to happen. Iron condors, that's probably one of my favorite things to do as far as short vega strategies through earnings reports. You basically just get like 20 to 25 delta iron condors, or you can put a little bias, bullish or bearish on it, and you get a nice IV crush for iron condors, right? Straddle strangle swaps, right? That's another really good short vega strategy that you'll benefit a lot from the drop in IV. Butterflies, that's another good one. Those are slightly short vega, right? Iron flies. Another thing you could do is broken wing butterflies too, right? Those are not technically short vega, but it's essentially like zero vega, right? You're barely going to get any effect from the IV at all. Iron flies, if you don't know what an iron fly is, look it up, but it's basically an iron condor where the short strikes are touching. Ratio spreads, I don't do those too often, but they do. There are certain times when they're effective, right? And ratio spreads is something that you could definitely do for an earnings report. It is short vega, so if you're confident in that kind of setup, go for it. Short diagonals, that's another one that you can make some good money off of. Calendars and diagonals, right? And I put question marks there because obviously some would argue against me saying that, because when you read about calendars and diagonals, they say that they're long vega, and you're supposed to use them in low IV environments. But, here's the thing, right? Yes, they are net long vega, but the short calls, right? The short calls on the near dated strikes, they have higher IV, right? They have higher IV and they have lower vega, right? The long dated ones have lower IV and a little bit higher vega, right? So again, like those long dated ones, and I have the bullet point down here, the short term options have extremely elevated IV compared to longer term options, right? So as long as you are right about direction, you're going to make money, right? So that short term, let's say you're doing a call diagonal or a call calendar, right? That short term weekly option has super high IV compared to that long term option that's like 4 weeks out, right? So again, that 4 week to expiration call is going to experience way less IV crush compared to the short term one, okay? So, it's a good strategy, in my opinion. I've done it a few times and it works fairly well, right? So, as long as the stock doesn't rocket way past your strikes on the upside and it doesn't tank way below, you'll make money. If the stock opens flat, you're going to make money. If the stock goes up towards your short strikes and your long strike, you're going to make money, right? You aren't going to be affected by IV crush like you think you are, okay? So that's basically all I wanted to cover for IV crush in this video here. I hope you guys learned something. I'm going to do probably a video on IV rush as well. I don't know. If you guys have any special requests, just leave a comment in the comment section or ask in the Discord. That's all I have for you guys for tonight. Take care and have a good week.